Umbrella insurance isn't usually the first thing people think about when they picture retirement planning. Most conversations focus on saving enough, investing well, reducing taxes, and creating income. But in retirement, one serious lawsuit can create a very different kind of risk. Not just a temporary setback, but a threat to savings you may no longer have decades to rebuild. So in this episode, I'm simplifying how umbrella insurance works for retirement savers. Specifically, I'm sharing why liability risk doesn't necessarily disappear after your working years, what umbrella insurance does and does not cover, 5 common mistakes people make when buying or reviewing a policy, and a simple 4-part formula for estimating how much coverage you actually need. You'll also learn why the common match coverage to net worth rule can be misleading and why coverage may still make sense even when the math says you don't technically need it. Welcome to another episode of the Stay Wealthy Retirement Show. I'm your host, Taylor Schulte, and every week I tackle the most important financial topics to help you stay wealthy in retirement. And now, on to the episode. Let's start with why umbrella insurance can become especially important in retirement. During your working years, yes, a major lawsuit would certainly be painful, but in many cases, the financial damage was at least somewhat recoverable. You still had future paychecks coming in, and you still had years, maybe even decades, to save, invest, and rebuild before retirement. So if a judgment wiped out a meaningful portion of your savings, yes, it would be a serious setback, but not necessarily a permanent one. Retirement is different. At this stage, the savings you've accumulated are largely what you have. There usually isn't another 10 or 20 years of earning, saving, and rebuilding ahead of you. So the same lawsuit that might have been recoverable at age 45 can be much harder to absorb at 65. And that's what makes liability risk in retirement so important. It's not just the likelihood of something happening, it's the consequence if it does. Now, many retirees assume their liability risk naturally goes down in retirement, and on the surface, that makes some sense. Your kids and their reckless friends are out of the house. You're no longer commuting every day during rush hour. You may not have employees, clients, or business-related liability anymore. And with more control over your schedule, life can just feel slower and simpler and less exposed to risk. But the reality is that retirement doesn't magically remove liability risk from your life. It just changes where that risk tends to show up. For example, you may drive fewer miles overall, but retirement often shifts your driving into errands, appointments, travel, and unfamiliar places where accidents can still happen. In addition, you may actually have more people coming in and out of your home than you assumed, like grandkids, neighbors, contractors, housekeepers, dog walkers, or even caregivers. You may also be traveling more, hosting more, letting friends and family use a vacation home, or simply spending more time in situations where one honest accident can create a claim that exceeds your regular insurance limits. And these claims don't always come from unusual or extreme events. A guest slips and falls in your home during a holiday party. A grandchild's friend gets hurt in your pool. A contractor is injured on your property and argues that unsafe conditions contributed to the injury. Or, as I've shared before, you're driving to an appointment, you misjudge a light, and accidentally hit a high-earning professional whose injuries lead to a large claim for lost income and medical costs. These are not everyday events, but they can arise from everyday parts of life. And when they happen, they can move quickly from a small insurance issue to a 6 or even 7-figure problem. That's the real reason umbrella insurance matters in retirement. Yes, the odds of a major liability claim are still low, but retirement planning is partly about protecting against low probability events that could create sizable and even permanent damage. And that's exactly what insurance is best used for. Not for small, manageable risks many of our listeners can likely afford to self-insure, like iPhone insurance, extended warranties, or extra rental car coverage, but for the large, unpredictable risks that could put a retirement plan in jeopardy. Umbrella insurance fits that category because it can provide a meaningful layer of protection against catastrophic liability claims at a relatively low cost. But before you decide how much of that protection you need, you have to understand what is actually exposed. And in retirement, that's not always as simple as looking at your net worth, because two retirees can both have a $3 million net worth and have very different liability exposure depending on where that money is held, how their income is paid, and what state they live in. So the next question is, where is your retirement income actually coming from, and where are your assets held? A common misconception is that once you stop working, you don't have wages that can be garnished, and therefore there's not much left for someone to take from you. But that's not quite right. In fact, a judgment can follow you for years, sometimes even decades. And while some retirement assets have strong protections, those protections are not the same across every account type. For example, ERISA qualified plans, which generally include most 401ks and many 403bs, have very strong federal creditor protection while the money remains inside the plan. So if you have a large balance sitting inside a qualifying 401k, those plan assets are usually much better protected than money sitting in a taxable brokerage account, checking account, or investment property. IRAs are a little more complicated. For federal bankruptcy purposes, the law treats two types of IRA money differently. The first is rollover money. These are dollars that started inside an ERISA-covered plan like a 401k or 403b and were later rolled into an IRA. Now, this is not legal advice, and there are some differences of opinion on the finer details, but in general, it's widely agreed upon by credible legal sources that rollover IRA dollars keep the same strong protection they had inside the ERISA-protected 401k. The second type is what I'll call pure IRA money. These are IRA dollars built from your own direct contributions and investment growth rather than money that originated in a 401k or 403b. Pure IRA money is still protected under federal bankruptcy law, but only up to a cap, which is currently a little over $1.7 million per person. Above that amount, protection may be more limited. And outside of bankruptcy, IRA protection is often governed by state law, which means the answer can vary quite a bit depending on where you live. So to summarize, some retirement accounts are very well protected, some are partially protected, and some protection depends on state law and the specific facts of your situation. And let's not forget that creditor protection can quickly change once money leaves a retirement account and gets commingled with other taxable assets. For example, a 401k distribution that lands in your checking account no longer has the same ERISA protection it had inside the plan. The same applies to IRA or Roth IRA withdrawals. If the money is immediately spent, sure, there may not be much left for a creditor to reach. But if those dollars sit in a checking, savings, or brokerage account, the protection picture can change. And in retirement, that matters because distributions are not always spent right away. RMDs may exceed your actual spending needs. Larger withdrawals may be set aside for taxes or major expenses. And some retirees intentionally build cash reserves outside of their retirement accounts. Once protected retirement dollars move into these places, they may become more exposed. That's why umbrella insurance can still matter in retirement even when much of your wealth is held inside retirement accounts. It gives you an added layer of protection between a serious liability claim and the assets you're relying on to fund the rest of your life. But like any insurance policy, the details matter. An umbrella policy can be incredibly useful, but it's not a blank check and it doesn't protect against every possible risk. So before we talk about how much coverage you need, let's just quickly walk through what umbrella insurance actually is, what it typically covers, where it usually stops, and a few common mistakes retirees make when reviewing their policies or securing a new one. At the simplest level, a personal umbrella policy is extra liability coverage that sits on top of your existing auto and homeowners insurance. As you may already know, each of those policies has its own liability limit. For example, you might have $500,000 of liability coverage on your auto policy and $500,000 on your homeowner's policy. If you're sued after a covered claim and the damages exceed one of those limits, the umbrella policy can pick up where the underlying policy leaves off, subject, of course, to its own terms and exclusions. So if you have $500,000 of auto liability coverage and a $2 million umbrella policy, you can have up to $2.5 million of total protection for a covered auto liability claim. The same general idea applies to your homeowner's liability coverage. For example, if someone is seriously injured at your home and sues you, your homeowner's liability coverage would typically respond first. If the claim exceeds that limit, your umbrella policy may provide additional coverage above it. And this is where umbrella insurance can be especially valuable because it's not just about the final settlement amount or judgment. Many umbrella policies, at least the good ones, also help cover legal defense costs, meaning it pays for the attorneys hired by the insurance companies to defend you. And those costs can add up quickly. Even a lawsuit you eventually win can be expensive, stressful, and time-consuming to defend. But umbrella insurance, as great as it is, does not cover everything. In most cases, it extends your liability protection for covered personal activities. However, if the underlying claim is excluded from your auto or homeowner's policy, your umbrella policy will likely exclude it too. So, needless to say, it's important to understand where the gaps can show up. And while there are dozens to be aware of, I'm going to share 5 of the most common exclusions with you today. The first exclusion is business activity. Maybe you're still working, or maybe you're doing some part-time consulting in retirement. Either way, if a client comes to your house for a meeting, falls down the stairs, and sues you, your personal umbrella policy may not cover that claim. You'll likely need separate business liability coverage instead. The second common gap is board and leadership roles. Many retirees serve on a condo association board, nonprofit board, school board, or even a corporate board. That can be meaningful work, but it can also create liability exposure, and your personal umbrella policy may not cover claims related to those roles. In many cases, you would need directors and officers coverage, or you'd want to confirm that the organization already has it in place and that it actually covers you. The third exclusion is obvious, and that is intentional or criminal acts. If you accidentally cause an injury, that's one thing. But if you intentionally harm someone or do something illegal, your umbrella policy is not designed to protect you from the consequences. So, if you lose your cool at the next HOA meeting and throw a chair across the room and injure someone, I hate to break it to you, but your umbrella policy probably isn't going to admire your passion for proper landscaping. The fourth exclusion, and this is one many people misunderstand, is damage to your own property. Umbrella insurance is liability coverage. It protects you when someone else claims you caused harm to them or their property. It does not protect your own home, your own car, your own jewelry, or your own artwork. And it does not pay for your own medical bills. Those are homeowners, auto, health, or personal property insurance questions. And lastly, there are policy-specific exclusions. For example, some umbrella policies may exclude certain dog breeds. Some may exclude certain vehicles, recreational equipment, rental properties, or higher-risk activities. And these exclusions can vary from one carrier to another, which is why it's worth reading the fine print and asking your agent a very direct question during your next insurance review. What are the biggest things my umbrella policy does not cover? Because the amount of insurance you ultimately purchase only helps if the policy protects the risks you are most likely to face. And this is where the conversation moves from simply buying an umbrella policy to making sure it's actually doing the job you expect it to do. Because even with a reasonable coverage amount, there are still a handful of ways retirees can create gaps without even realizing it. So before we get to the 4-part formula for calculating how much umbrella insurance you actually need, let's walk through 5 common mistakes that can undermine this whole risk protection strategy. Some of the mistakes tie back to the account protection rules, policy exclusions, and coverage requirements we just discussed, but that's intentional. The goal here is to turn the details we've discussed up to this point into more of a practical checklist so that you're aware of some of the key things to look out for next time you review your policy or explore buying one for the first time. The first mistake is one that we can breeze through quickly, which is assuming all of your retirement money is untouchable. As we already discussed, ERISA accounts have very strong protection, but pure IRA protections can vary and have federal caps. So don't assume that every dollar inside every retirement account is fully protected. For many retirees, umbrella insurance still plays an important role, even when a large portion of their wealth is held in retirement accounts. The second mistake is letting your underlying coverage drop too low. You see, most umbrella policies require you to maintain certain minimum liability limits on your home and auto policies before the umbrella coverage kicks in. For example, a carrier might require $300,000 of personal liability coverage on your homeowner's policy and $250,000 per person, $500,000 per accident on your auto policy, plus property damage coverage. Those numbers can vary by carrier, so the specific limits are less important than the concept. The key point here is that if you ever decide to trim expenses in retirement and reduce those limits below your carrier's minimum, you may unintentionally disqualify yourself from umbrella coverage. So before making any changes, be sure to ask your insurance agent, what underlying limits do I have to maintain for my umbrella policy to work properly? The third mistake is assuming new risks are automatically covered. Retirement can introduce liability exposures that were not part of your life before. Maybe you buy a golf cart, a boat, a second home, or a rental property. Maybe you add a pool, get a dog, start hosting family more often, or begin volunteering in a role that carries liability risk. Some of those risks may be covered by your umbrella policy. Some may require a separate policy, an endorsement, or higher underlying limits. And some may be excluded altogether. The key is to tell your insurance agent when something meaningful changes. Don't assume your umbrella policy automatically follows every new asset, activity, or responsibility that you add in retirement. The fourth mistake is waiting until you feel at risk. And this is a big one because umbrella insurance has to be in place before anything happens. These policies only cover incidents that occur after the coverage is active. So you cannot wait until after an accident, injury, or lawsuit to buy a policy and expect it to protect you. Even if a claim has not been settled yet, insurers will treat it as a known risk, which can make coverage harder to get and even more expensive. The right time to put an umbrella policy in place or increase your coverage is before anything happens, because by the time you feel exposed, it's likely too late. Lastly, the fifth mistake I want to highlight is treating umbrella insurance as a set it and forget it decision. Even if your policy was the right fit when you bought it, that doesn't mean it will still be the right fit 5, 10, or 15 years later. Your assets may grow, your home value may appreciate, liability costs may rise, you may move to a different state with different creditor protection rules, and the amount of coverage that felt sufficient at 55 or 60 may no longer be enough at 70 or 75. So just like every other area of your financial plan, build an annual insurance review into your planning routine. At least once a year, review your umbrella limit, your underlying home and auto coverage, your exclusions, and whether the policy still matches your overall risk picture. Or, if applicable, share the full policy details with your financial planner and let them do the heavy lifting for you. Now that we've covered what umbrella insurance does, why retirees still need it, where the gaps can show up, and which assets may already have some level of protection, we can finally turn to the practical question. How much coverage do you actually need? The most common rule of thumb is to match your umbrella coverage to your net worth. In other words, if your net worth is $3 million, you buy $3 million of umbrella coverage. That's not a terrible rule, and I've shared it before here on the podcast. But similar to the 4% rule in retirement income planning, it's only a quick reference point. It gives you a number to work from, but it doesn't account for the details that can materially change the answer. So yes, your net worth still matters. It just shouldn't be treated as the final answer. Instead, it becomes the first of 4 specific inputs that can help you arrive at a more informed coverage decision. So let's start there. Your net worth is the first input because it represents the ceiling. It represents the most you could theoretically lose if a serious liability claim turns into a judgment. As a general rule, you probably don't need umbrella coverage that's wildly higher than your net worth. At some point, there simply isn't much more balance sheet left to protect. But there is an important nuance here. If you're still working, especially if you're a high earner with several peak income years ahead, your future wages may belong in the conversation too. That's because a judgment that exceeds your assets and insurance coverage may be satisfied, at least in part, through wage garnishment, subject to federal and state limits. Federal law generally limits ordinary wage garnishment to 25% of disposable earnings, and some states do provide additional protections. So while future wages are not technically part of your net worth, they can still affect your liability exposure. The second input is the slice of your net worth that's already protected as home equity under your state's homestead rules. You see, most states still offer some form of homestead protection that shields part of the equity in your primary residence from certain creditors. However, the details continue to vary a lot by state. For now, there are two practical things to know. First, this homestead protection typically applies to your home equity, not the full market value of the house. So, for example, if you own a $1 million home with a $600,000 mortgage, the law is generally looking at the $400,000 of equity, not the full $1 million of value. Second, the dollar amount that's protected is all over the map, depending on where you live. In California, for example, the homestead exemption is pegged to the county's median single-family home sale price with a minimum and a maximum that gets bumped up for inflation over time. For 2026, that range runs from roughly $371,000 to a cap of about $743,000, which means in many higher-cost counties, a $400,000 equity position is fully covered by the current exemption. So, if a meaningful chunk of your balance sheet is home equity that falls under your state's homestead exemption, that slice is already largely insulated from many types of unsecured creditor claims. From a coverage sizing standpoint, that portion of your net worth usually doesn't drive how much umbrella liability insurance you need. Input number 3 is retirement accounts that are already creditor protected. As I mentioned earlier, this is not legal advice and you need to talk to your trusted advisors, but in general, ERISA qualified accounts like most 401ks and 403bs receive very strong federal protection with no specific dollar cap. It's also generally agreed upon that rollover IRAs that trace back to an ERISA plan typically keep that protection as well. For many high savers, this is the biggest single piece of the calculation. If most of your retirement money started in 401k type plans and was later rolled into IRAs, the bulk of that balance may be hard for most creditors to reach, and you may not need to rely on umbrella insurance to protect it. Lastly, input number 4 is your existing liability limits. As we've already discussed, umbrella doesn't kick in until your underlying auto and homeowner's liability is exhausted. Now, the state-mandated auto minimums are usually tiny, often $10,000 to $15,000, but you're often required to carry a lot more to qualify for umbrella insurance. If you maxed out your liability insurance on your auto and home at, let's say, $500,000, that's your first layer of defense. Umbrella coverage only matters for exposure above those limits. With those 4 inputs in mind, here's a simple way to think about the math. Start with your total net worth plus any future wages you want to factor in. From there, subtract the portions that are already hard for many creditors to reach, like the home equity protected under your state's homestead rules and any retirement accounts that receive strong creditor protection under federal or state law. Finally, subtract the liability limits on your auto and homeowners policies, since those are your first line of defense before an umbrella policy ever comes into play. The amount that's left is a rough estimate of the additional liability cushion an umbrella policy may need to provide, subject to the specific laws in your state and the advice of your own legal and insurance professionals. In other words, the formula is still just the starting point in your decision-making process. After following each step and crunching the numbers, it may tell you that you only need a small umbrella policy, or in some cases that you might not need one at all. But in real life, I'd be careful about letting the spreadsheet make the entire decision for you. As discussed earlier, umbrella coverage is relatively inexpensive compared to the amount of protection it provides. And even if certain assets appear to be hard for creditors to reach, that doesn't mean a lawsuit is painless or even avoidable. Anyone can sue anyone for anything, and even if the claim is weak and you ultimately win, legal defense costs, stress, and uncertainty can still take a toll. There's also the reality that asset protection laws, homestead rules, and creditor protections are not permanent. They can potentially change in the future, and it's possible you may not want to spend your retirement tracking legal updates, wondering whether your protection still works the way it did when you first ran the numbers. So, with all of that in mind, I would add one final bonus input to the formula, the SWAN input, aka the sleep well at night input. Maybe the math says your exposure is limited, but if paying a reasonably priced annual premium gives you an extra layer of protection, reduces anxiety, improves your sleep, and helps protect against the possibility that your real life doesn't line up perfectly with the spreadsheet, then meaningful umbrella coverage may still be worth it. Just like most people don't build a retirement plan around saving the absolute least amount they need, umbrella insurance shouldn't be about buying the smallest policy the math allows. It's about creating a margin of safety against the kind of liability event that could derail an otherwise well-built retirement plan. Now, before we wrap up, there are a few practical details about umbrella insurance I want to be sure to leave you with. The first is how the pricing works. Umbrella coverage is typically sold in $1 million increments, and one detail that often gets missed is that the first $1 million of coverage is usually the most expensive. Depending on the carrier, your underlying home and auto policies, and your overall risk profile, that first $1 million might cost somewhere in the ballpark of $250 to $600 per year. But after that, each additional million is usually much cheaper. In many cases, adding another $1 million of coverage might only cost an extra $75 to $150 per year. So, moving from a $1 million policy to a $3 million policy is often a few extra $100, not 3 times the cost. That matters because once you've decided umbrella coverage makes sense, the difference between barely enough and comfortably more than enough may be relatively small in dollar terms. And that's why, all else equal, I do tend to favor a little more coverage rather than trying to cut it too close. The second point is the insurance carrier itself. And this is where I often see gaps for higher net worth retirees. If your home, auto, and umbrella coverage are all with a heavily advertised mass market insurance company, that does not automatically mean you have bad coverage. For many households, those carriers can be perfectly adequate. But as your balance sheet grows, your insurance needs often become less standard. You may own multiple properties. You may have teenage drivers. You may entertain frequently. You may sit on nonprofit boards or employ household help. Or you may simply have enough visible wealth that, whether fair or not, you could be viewed as a more attractive litigation target. And that's where the type of carrier can start to matter. Mass market insurers are generally built around price, scale, and standardized policies. That can work well for many people, but higher net worth households may benefit from carriers that are specifically designed for more complex risks. Companies like Chubb, Pure, AIG Private Client Group, and Cincinnati Insurance often serve this market. They may offer broader policy language, higher available limits, more flexible underwriting, and claims handling that is better suited to larger and more complicated liability situations. Again, this does not mean everyone needs a high net worth insurance carrier, but if you have meaningful assets and you've never had your policies reviewed through that lens, it's worth asking whether your current coverage is simply inexpensive or whether it's actually appropriate for your situation. The final detail is one that is easy to overlook but can be extremely important, and that is how legal defense costs are handled. When you review your umbrella policy next, consider asking whether defense costs are paid inside or outside the policy limits. If defense costs are paid inside the limits, that means they would reduce the amount of coverage available to pay the claim. So, for example, if you have a $1 million umbrella policy and the legal defense costs are $200,000, you may only have $800,000 left to pay damages or a settlement. But if defense costs are paid outside the limits, then the insurance company pays those legal costs separately and your full $1 million limit remains available for the claim itself. In a minor claim, that distinction may not matter much, but in a serious lawsuit that drags on for months or even years, legal fees can become a major part of the total cost. So next time you review your policy, don't just ask, how much umbrella coverage do I have? Ask how the coverage actually works, because two policies with the same $1 million limit can provide very different levels of protection once attorneys, court costs, and claim expenses enter the picture. Stepping back from all the details we discussed today, here's what I hope you take away from this conversation. Most retirement planning conversations focus on offense, saving more, investing better, generating income, managing taxes. Those things certainly matter, and they get the majority of attention for good reason. But as your time horizon shortens and your ability to rebuild fades, the defensive side of your plan starts to carry more weight. That's also the part of retirement planning that's hardest to feel good about because you're paying for things you hope to never happen. There's no satisfying return on an insurance premium that didn't have to pay out, but that's exactly what makes it valuable. the best protection often goes unnoticed precisely because it's doing its job. Umbrella insurance fits squarely into that category. It's not glamorous, it doesn't show up on a performance report, and it does not compound over time. But it does something the rest of your plan cannot easily do on its own. It puts a cap on how bad a bad day can be. And in retirement, where the consequences of a bad day are harder to absorb, that cap, in my opinion, is worth a lot. So whatever you decide to do with your umbrella coverage going forward, whether that's keeping what you have, increasing your limits, switching carriers, or finally putting a policy in place, try to think about it through that lens. Not as another line item on your insurance bill, but as one of the quieter places of a well-built retirement plan. The kind of piece that, if it ever has to work, you'll be very glad you took the time to get it right. Thank you, as always, for listening. And once again, to view the research and resources for this episode, just head over to youstaywealthy.com/285.
This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. This podcast is not engaged in rendering legal, financial, or other professional services.